Meet Jim. Jim uses his health savings account to put away cash through a payroll deduction completely tax-free. It's like having a coupon, which saves you on average 15 to 25%. His employer puts money into his account as well, completely tax-free. He knows that unexpected medical emergencies pop up throughout the year. Say his daughter breaks an arm on the playground. The HSA is there to pay the deductible. It can be used to pay other qualified ongoing medical expenses too, like dental care, eyeglasses, and prescription medications. And you can pay for these expenses after your insurance plan network discounts are applied. You can also use your account to pay COBRA, long-term care, and Medicare premiums. But you can use the HSA only for qualified expenses. If you pay for any non-qualified expenses, your income tax rate plus a 20% tax penalty will apply. Jim's account has an HSA debit card, so all he has to do is swipe to pay. In order to qualify for the HSA, Jim had to enroll in an HDHP, also known as a high-deductible health plan. He was excited about how much he saved in premium contributions by choosing this plan versus a standard PPO copay plan, and is setting aside this estimated savings every payroll period into the HSA account. Jim knows it's better to put these dollars into an account for him versus spending them on an insurance premium. Every year, the IRS establishes the maximum amount that can be put into an HSA, which includes a combination of Jim's contributions and his employer's. This IRS limit is tied to Jim's HDHP plan election, so Jim is subject to the single coverage tier limit. An HSA account can really build up quickly because it's an interest-bearing account that carries over year after year. This means Jim doesn't have to scramble to use what is left in his account at the end of the plan year. He can let the account build up until he truly needs it. The account is in Jim's name, so he can take it with him if he changes employers. He can continue to use his HSA dollars for qualified expenses without a penalty, even if he doesn't enroll in a high-deductible health plan. What's even better? Once he reaches age 65, he can use the money in the account for anything. That's right, the qualified medical expense requirement doesn't apply once you reach age 65. Therefore, the 20% tax penalty doesn't apply. Jim thinks of his HSA as a separate nest egg for the future and plans on using part of it to buy an RV to tour the United States in his retirement years. A few ground rules to keep in mind. To put money in an HSA, you must be enrolled in only a high-deductible health plan. You cannot put money in an HSA if you're enrolled in Medicare benefits, claimed as a dependent on other person's tax return, doesn't include spouses, not a U.S. citizen, active military, you or your spouse have a medical flexible spending account regardless of whose expenses the account is used for, dependent care and limited FSAs, those used for dental and vision only, don't prevent you from having an HSA. Even though Jim can only set aside up to the single IRS limit into his HSA, he knows he can still use HSA dollars to cover copays and other qualified expenses for dependent children on his tax return and his spouse, who are not enrolled on his HDHP. A high-deductible health plan with a health savings account makes a lot of sense for Jim. This program could save you money as well.